Hey, baby. Hey, I'm shooting a video. Can you go play?
Hey real estate investors, what's up? My name's Hayden Crabtree, and today we're gonna talk about the 4 ways that real estate can help you avoid, reduce, minimize, all legally get rid of taxes. If you're in real estate, you might already know some of these strategies, and then we're probably gonna get into some more advanced ones that really even advanced real estate investors have never heard of. Let me preface this, I am not a CPA, I am not a tax attorney. If you wanna follow through on some of the things that we talk about here, seek professional advice. What I'm giving you is not advice, it is ideas for you to explore. Depreciation, if you're a real estate investor, you've heard of it. Simply what this means is that over time, the building that you own, the building on your property is going to go down in value. Why is it gonna go down in value? Because it's being used, because it's sitting out inside the elements, right? You know, the structure here that I'm under, it has a roof on it, it has a foundation, it has walls, it has electricity running through it. Through time, this structure would not look the same. The roof is probably all faded, the electrical wires maybe have corroded, a lot of things have happened. That, in a real sense, is what depreciation is. Why depreciation is good for taxes versus why it's bad to actually have things depreciate. You get to, every single year, take what is occurring as an expense. But the answer is, did you actually have any expenses occur? And the answer is no. And so depreciation is what we call a ghost expense. Ghost expense is something that we don't actually have to pay, but we're allowed to write off on our tax returns. That's a ghost expense. The reason that this is so powerful is in a residential structure, you can take it off of 27.5 years. On a commercial structure, you can do 39 years. So let's say we buy a house for $300,000. The land is worth $25,000, and the house that we bought there is worth $275,000. So first off, we have to break those two components apart into the land, which is not depreciable. You cannot depreciate land, and the structure, which is, we have $275,000 worth of value. And so if we just ride that out, we're gonna get a $10,000 a year ghost expense. $275,000 divided by 27.5 years is $10,000 a year. So let's go through an example. Let's say I rent this house out for $20,000 a year. Let's say that my expenses are $5,000 a year. You know, let's just say that I cash flow $15,000 a year on this house, just making up numbers here. I have $15,000 of taxes that I would have to pay. I would have a taxable income of 15 grand, but thanks to depreciation, what's gonna happen is I get to ghost expense $10,000 of depreciation. Now again, did I actually have to pay the $10,000 in that year? No, but I get to write off. Now my taxable income on this, I profited, cash flowed $15,000. I'm only going to pay taxes on $5,000. That $15,000 of taxable income minus the $10,000 of ghost expense, $5,000 of taxes, okay? So that's how it can help, but what can really be powerful, and I call this, you know, depreciation steroids in my book, Skip the Flip, which if you want a free copy, PDF audiobook in the link below. What is so powerful is depreciation steroids, which in the real world, cost segregation studies. What this does is it goes in and it looks at each individual component. And so it would say, the IRS sets these rules out, but it would say the roof has a useful life of 5 years. The foundation has a useful life of 10 years. So it'll allow you to go in and look at each individual component of that structure, and then what that's gonna do is it's gonna allow you to accelerate each of those. So now we're really not depreciating our $275,000 over, let's say, 27.5 years. We're gonna take each of those components year by year, break it down into a value, and we're gonna apply that into potentially up to 40 to 50% of that $275,000 in year one. So let's use the 50% number, okay? Depends on the makeup of the building, what kind of structure you have, et cetera. But let's say it's half of that $275,000. That would come out to, and I'm gonna do this math, 275 divided by 0.5 or times 0.5 is gonna give us $137,500. So same numbers, let's say I made $15,000 of cash flow, that was my taxable income. Well, now I've got $137,500 of ghost expenses that I'm gonna take in year one. And so what I'm gonna do is figure out what my taxes are. So 15,000 minus that number gives us, I'm gonna report a $122,500 loss on that property in year one. Now, why am I gonna do that? I'm gonna do that because as a real estate professional, I can take that $122,000 loss from this one property and I can use it to shield any other income that I may have made. So if I worked and I made, 200 grand somewhere else and I was going to pay taxes on 200 grand. Well, guess what? Now I made that $15,000 from the property absolutely tax-free, and I'm going to take a $122,000 loss and apply it to my other monies, and I'm going to use that to reduce the taxes from $200,000 down to $78,000, $77,500, okay? So that's the power of depreciation. That's how it works. If you don't believe me, talk to a CPA. The next way that you can legally avoid taxes is through a 1031 exchange. Code 1031 of the IRS rulebook, tax code, wherever it's found. This is called a like-kind exchange. Simply what that means is that if you have something, you can sell it and you can move that money into something else that is like it and not pay any taxes. So let's say that we buy that $300,000 property in 2019. Let's say we turn around and sell it in 2022 for $500,000. We have $200,000 worth of gain there. If we were to sell that, we'd have to pay long-term capital gain, which right now at the federal level is 15 or 20%, plus you'd have to pay whatever it is in your state. So let's say it's 22, 24% that you end up having to pay, which that can be almost 50 grand of taxes you'd have to pay. But if your goal is to instead move that $200,000 of gain plus whatever other equity you had in that property into more real estate for a better opportunity, you can do that tax-free through a 1031 exchange. That's all you really have to know. The other kind of facts you have to know is you have to buy more. If I sold for $500,000, I'd have to buy at least $501,000 worth of stuff. And you have, from the time you sell that property, you have 45 days in order to identify an additional property you want to buy. You can only identify 3 properties. And if you identify more than that, you have to buy all of those properties. The combination of 3 properties, you can buy 1, you can buy 2, you can buy 3, you can buy 4, you can buy 10, you can buy 100. Just don't identify more than 3 if you plan on buying all of those. The combination of all of those purchases has to equal more than that $500,000 to be legitimate, okay? So that's a 1031 exchange, super easy. Whenever you go to sell, you just tell the people who are closing the deal, you say, hey, I want to 1031 this, and you have to tell them who your qualified intermediary is. The qualified intermediary is the person that whenever you sell the property, the money gets sent to a qualified intermediary, also called a QI, and a QI will hold your money. If you're going to 1031, you personally are never allowed to touch that money, or if you own your property in LLC, your LLC is never allowed to touch that money. It can never come into your bank account or your possession. It always has to stay with the QI. And then whenever you turn around and you're buying those additional properties or property, you just have your QI send the money to there, and it works all the same. Nothing changes with your debts. Everything works the same. You can still go get loans. Everything else is the same. All right, so next up is an opportunity zone. This is the third way that you can avoid taxes through real estate investing. Opportunity zones are federally designated areas that need love, right? They need TLC. Most of the time, and I hate to state it this way, but I'm just telling you what I've observed, is that opportunity zones are generally either areas that have kind of suffered from a natural disaster, like say a tornado ripped a town apart really badly, it needs to be put back together, or say a hurricane or something like that. Normally it's from a natural disaster, or normally it's just a really low income area that needs economic growth. Those are the 2 areas that I've seen opportunity zones in. What an opportunity zone is, if you make an investment here, and if you hold this investment for at least 10 years, no matter how much money you make, as long as you hold it for 10 years, you can sell on the backside and you don't have to pay any taxes. And now there's some sort of scale in between. Like if you hold for 5 years, you still have to pay taxes, but it's a reduced rate if you hold for 7 years, and that's kind of how the opportunity zone works. But to get the full benefit of an opportunity zone, you need to go in knowing that you're gonna hold that investment for 10 years. Now, some really cool ways that this could work is you could 1031 into a property in an opportunity zone, hold for 10 years on the back end and sell, and you would never have to pay any taxes, even on your previous gains through 1031 exchanges. So that's really cool. But you also have to think about what the tax savings is really getting you out of an opportunity zone. Is it really worth having your money and your energy tied up in a low income area for 10 years? So if you're gonna do this, just know and run the numbers to say, am I better off doing this to avoid paying taxes? Am I gonna have an overall higher IRR at the end of the day? Or would I be better off going investing in a non-opportunity zone and potentially making more money because the market that it's in is going to flourish, and I'm just going to make more money even if I were to pay my taxes at the end of the day? What do I net out on? So opportunity zones are pretty cool. I also think they're pretty limited. You have to know the pros and cons of it. And again, make sure to consult with an opportunity zone professional before you go into this. I've never done an opportunity zone. I've heard about them. I've learned about them. Never really got quite drawn into them. Number 4, how to avoid taxes. This is called conservation easements. What a conservation easement essentially is that you're guaranteeing that this property that you're foregoing profit on will always be inside of, it won't be developed, right? You will not capitalize upon that opportunity. It will be put into a conservation status, which whenever we think of conservations, it's things like forests that are never touched and this are just gonna be wildlife. And so if you have, let's just use an example. Let's say that you have 10 acres that you're gonna build an apartment complex on. You go buy the land for $1 million. You say that you can build the apartments for $4 million, bringing total project cost to $5 million. And let's say at the end of the day, you thought that the project was gonna be worth $15 million, which represented $10 million of profit opportunity. Now remember, you had to pay the $1 million for that land. Nothing changes on that. And remember, land itself is not depreciable. But what you're gonna do is you're gonna drop this into a conservation easement and you're gonna say, I'm going to take a $10 million write-off because I forego this profit and I will never build this project and nobody else will ever build this project on this land. We will keep it, we will conserve it and drop it inside of this conservation easement. Okay, so that again, it's how it works. You spend $1 million to get a $10 million tax write-off, which if you make enough money to be in the 30, 35+% tax bracket, then that $1 million you spent is saving you $3.5, $4 million of potential taxes paid. So it's a net gain overall of $2.5 to $3 million, which can be really good and it makes it worthwhile. Thing is that a lot of people have abused this through the years. They've said that their profits were going to be wild. There really was no one kind of checking these numbers. They were taking these write-offs and the IRS has started to crack down more on this. So this is legal, it is acceptable, but just know that people have abused it and the IRS is starting to crack down more. Check your numbers, make sure everything makes sense. But if you make really high income, there's a couple pieces here. You have to buy the land, you have to buy the $1 million of land or whatever the scale is, right? You have to make sure that there's a substantial profit on the line. You have to make sure you have a lot of taxable income and you have to make sure it's all legitimate or else you're lying, and that's illegal. You can't do that. So, but there is possibilities of ways to make that happen. So those are the 4 ways that you can save and avoid illegally taxes through real estate investing. Probably the best tool to reduce your taxes, to keep more of your own income, and also the best long-term investment. So if you guys want to learn more about real estate investing, if you like this video, hit the like button, subscribe to the channel. I'm dropping content like this twice a week. I'm also on TikTok, Instagram, and I do some YouTube shorts as well. So if you're liking the content, drop me a comment below. I'll see you in the next video.